Good morning, everyone. This is Barry Knapp from Ironsides Macroeconomics. It's Monday morning, September 3rd, 7:25 a.m. Mountain Time. This is the introductory version of our audio and video that summarizes our weekly marquee product, the research note that we'd love you to consider becoming a full subscriber to. The note this week was titled On the Ledge. We began with a discussion of the three E's that has us concerned about the equity market. That's earnings, the economy, and the election. We then went on to discuss income and investment. Last week we got an upward revision to GDP, but we got our first look at gross domestic income, which has a far better track record for picking turns in the economy. And of course, income drives investment. GDI came in at 1.3%, not the 3% that GDP produced. Those two are supposed to be equal over time, but we find that the way more often than not they do come into equilibrium is through revisions to GDP, in this case, most likely down. We then went on to discuss weaker labor market demand in August. Some in the street are looking for an uptick in employment growth in August and a little bit of a downtick in the unemployment rate. The data we're looking at does not support that. We then reviewed the Jackson Hole Economic Symposium conference beyond Powell's speech, the four papers that was presented, and some of our frustrations that the academic community that supports the Fed is unwilling to criticize them, particularly around the use of their balance sheet, QE and QT, and then wrapped it up with some final thoughts on the market. So the earnings outlook for us is not all that great. We've hit peak recovery out of the 3/4 earnings recession that came in the fourth quarter of 22 and first half of 23. We were comping to that in the second quarter, so we did get low double-digit earnings growth. But for the third quarter, earnings growth is expected to deteriorate fairly sharply. Our net revisions by sectors measures are going down. And the next couple of weeks, we're going to get a bunch of industry conferences where we would look for the guidance to be fairly soft. We added a chart in the weekly about net revisions for the consumer-facing sectors, that is discretionary and staples, and they look very soft. The economy doesn't look great to us either. I've already mentioned GDI being a better indicator than GDP and driving investment lower. And the labor market data we received recently, the Conference Board labor differential survey, which has been around nearly as long as the household survey, that nailed the uptick in the unemployment rate last month, was revised down for July and fell further in August. So we think the unemployment rate's more likely to go up than down this go around. And the regional Fed surveys are soft. Of course, back to those benchmark revisions, which are pointing to employment growth below 1%, something that typically happens at the beginning of a recession. That was true in 90, 01, and 08. Obviously, that's going to be the big focus this week is employment data. And just to be clear, we think bad will be bad, good would be good, meaning bad would be bad for the equity market. So moving on to our final thoughts on the market. We do think the probability of the markets threading the needle, getting an election outcome that doesn't get the bad tax policy outcome for equities, that would be a increase in the corporate tax rate, an increase in the capital gains rate, and even taxing unrealized gains. That's improved a little bit because the betting markets still have the Senate looking most likely like it's going to flip to the Republican Party, which would take some of those bad tax policies off the table. The earnings, but we don't see any real reprieve on the earnings or election outcome. And in the event that the labor market data does look okay this week and the Fed decides to only go 25 basis points, keep in mind that the 2-year part of the Treasury curve is discounting a very aggressive Fed policy path to 4%. And if they start with a 25 and the language doesn't really, or SEP doesn't really support that, well, you've got a lot of vulnerability in the Treasury curve. We could get a decent sell-off there. The seasonality Although everyone's talking about seasonality for the VIX and vol indices and the equity market, seasonality for the treasury market is pretty negative. Look through the last, half dozen years or so, we've tended to get pretty good sell-offs in the treasury market through fall. So that's not our base case. Our base case is the economy is weakening, but if somehow the data looks okay, the market is pricing a very aggressive Fed rate path here, and that could lead to just moving back into that mode where small caps, small banks, and all underperform, and tech leads, and again, this very bifurcated equity market. So again, our base case is that the equity market's going to be weak because growth is going to be soft and bad is going to be bad, but we just don't like the setup all that much for equities right now. So that's it for me, everyone. Have a good week. Barry Neff from Ironsides. Thank you.